Lena, I want to talk to you about Treasury. So let me pull up my chart of the hour, and it's looking at 10-year Treasury yields. This is as Federal Reserve last week signaled they are set to raise interest rates at their meeting in June. But actually, a lot of the officials we spoke to didn't really send a clear message on whether they'd hike one or two more times this year following that move. And that's kind of the May FOMC minutes, leaving that debate on 3 or 4 2008 hikes open. Where do you stand on how many times the Fed will hike?
I think the Fed has done a great job, Francine, and that's something, of course, you've covered tremendously on this show so many times, of balancing the message. Because the initial message that we got from the FOMC on the 1st and 2nd of May, the last FOMC meeting, was that the Fed is becoming more confident about the inflation outlook, that the US economy is now converging towards the Fed's dual mandate of 2% inflation and full employment, which kind of gives us very little reason why interest rates should stay as low as they are today for much longer. On the other hand, however, the minutes introduced that balancing act by suggesting that while the Fed is getting more confident on the inflation outlook, at the same time it's becoming more comfortable with the prospect of inflation overshooting above the Fed's 2% target, given the period of undershooting that we have had in recent years, which, of course, is very good news. It's been the gift that emerging markets needed, because it helped bring US 10-year yields briefly below 3%. It helped anchor them around the 3% handle. It also alleviated pressure on the dollar. And what that tells us at the margin is that the Fed is preparing now that once it gets to the interim estimate for its neutral policy rate level, which is a zero real rate for the short end, which will happen after maybe after 1.5 more rate hikes, then it will be possibly willing to sit back and await signals of the strength of the economy before responding to stronger inflation impulses from the US data. That suggests a steeper yield curve, a stronger medium-term growth and inflation profile, which is good news because it means a slower tightening of global financial conditions through this policy normalization cycle.
Lena, so we don't like jargons on this show, but actually if you look at R-star, which is the equilibrium real rate of interest, is that the kind of one of the things that we need to look at more in the future than we did in the past?
I think so, Francine. I think the Fed is hinting that as it gets closer to that infamous R-star, where the neutral level, we're not going to know, which is why I think the Fed is going to attach so much more significance to the marginal information to noise ratio that comes from the incoming US data, economic data, because it will tell us whether Fed policy has now turned restrictive, whether the economy is slowing down as a result of that. And it's clear that the Fed was actually very happy to let the economy run hot for a little bit, which, given that we talk about the biggest consumer in the world, is good news for emerging markets. It's good news for engineering a soft landing from that mega cycle of financial engineering that was quantitative easing in the past decade.